$169 million in revenue. A massive 99% year-over-year jump. $248 million in cash with absolutely zero debt. It looks flawless. But buried in the cash flow statement, almost $100 million is actively bleeding out the back door. This is the reality of the tape. We track and verify the public forecasts, the exact narratives institutions want you to trade on. We are targeting SoundHound, ticker symbol SOUN. For those uninitiated, SoundHound is the current artificial intelligence darling, specializing in voice and audio recognition software. The stakes for retail investors are incredibly high right now, because the headlines are screaming growth, while the filings are whispering danger. Just days ago, SoundHound printed what the market hailed as a blockbuster full-year earnings report. Revenue hit a record $169 million, effectively doubling their top line year-over-year. The balance sheet flashed $248 million in cash, with zero debt. It sounds like a complete victory. But as forensic auditors, we do not stop at the press release. We pulled the cash flow statement. Last year alone, SoundHound burned through $98 million in operating cash. To translate that into plain English, this company is a high-performance race car driving at top speed, but the fuel tank has a massive, active leak. That is exactly why you need FinWitness.com. We strip away the PR jargon to show you the verified metrics. Now, closing that file, and shifting our radar to the subsequent event. While the street was still digesting those earnings, SoundHound dropped a bombshell 8K regulatory filing. They are executing an all-stock acquisition of LivePerson, a legacy player in the customer service software sector. If you just skim the surface, it sounds like standard artificial intelligence expansion. But tear apart the term sheet, and you expose a brutal, highly calculated distressed M&A maneuver. SoundHound is not using their cash to buy this company. They are printing stock. They plan to issue over $300 million in new shares, handing the vast majority directly to LivePerson's secured bondholders. By forcing the target's creditors into a massive debt-for-equity swap, SoundHound protects its own pristine, debt-free status. The structural brilliance, and the inherent danger, is locked inside two hidden mechanisms in the legal fine print. First, the collar. To prevent a death spiral of dilution, the deal establishes a hard conversion floor of $7 per share. If SoundHound stock price craters, the share issuance is strictly capped at roughly 43.4 million shares. This firewall prevents legacy shareholders from facing total annihilation. Second, the survival wager. There is a strict $74 million penalty clause. If LivePerson's cash balance drops below $74 million at closing, SoundHound docks the final equity payout, dollar for dollar. The translation is clear: LivePerson is violently burning cash, and SoundHound knows it. So, what is the verified verdict? In the short term, the tape is strongly bearish. Up to 43 million new shares are about to flood the open market. Event-driven hedge funds are undoubtedly shorting SoundHound right now to lock in the arbitrage spreads. Prepare for massive technical selling pressure over the next 30 days. The institutions see this coming, but they are more than happy to let retail hold the bag. Long term, the outlook is neutral, but carries an extreme risk profile. Management successfully weaponized their high stock valuation to swallow a competitor without absorbing toxic debt. But the undeniable math is this: SoundHound, a company already torching nearly $100 million a year, just strapped itself to another cash-burning machine. Survival now depends entirely on post-merger execution, before they run out of fuel. The headlines are designed to sell, the filings are designed to tell the truth. By analyzing the latest earnings and SEC filings in real time every day, you are staying one step ahead of the market. To access the unredacted radar, visit FinWitness.com, upgrade to Pro today.